Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Daryl Thomas. And today we had the pleasure of interviewing Gareth Soloway of Verified Investing. Gareth, we need your help because a lot of folks are panicking right now. Markets are down significantly as of this recording, which is on November 4th. We know that there could be a headline or some catalyst that may drive the markets higher and such. And so these markets feel like a house of cards. So we definitely need some sanity to be preached to me and the audience today. So first off, I would love to get your overall take on the economy. We had Amazon cut jobs. I think UPS cut jobs, as well as we're in the midst of a shutdown. Things feel a lot slower. Want to get your take there.
Yeah, so I do think that the economy is slowing faster and faster. And I think the government shutdown is obviously adding to that. Although the idea is that once it reopens and all the employees essentially get the money, their back pay, then it could stimulate a little bit. But I don't think that alone is going to get us out of the trajectory of the economy, right? We've seen the repo market from the Federal Reserve. That's the emergency lending arm of the Federal Reserve. Banks have been coming to them. We know that per Jamie Dimon, he said, if there's one cockroach, there's many cockroaches. The idea here is that these banks could be in some trouble, or at least the possibility that trouble could be brewing. And I think these are things that, again, the markets haven't priced in. We're basically at all-time highs, a down day today. But again, price to perfection, where any sort of bump could create a big retrace in the markets.
Got it. Yeah, because I was thinking about the recent job losses, and then we had the big revision that was back at the end of the summer and such, and so that's definitely been a concern of mine. Yeah, go ahead.
I was just going to say too, one thing that's kind of jumping off at me is that you look at the capex by the AI stocks, and people are now saying that is 90% of GDP right now, and so you have to look at it and say, okay, well, 90% of GDP is just the capex spending. What is the rest of the economy really doing? And it really tells us that the majority of the economy and the majority of Americans are already feeling like we are in a recession. Yet stock prices don't reflect that because they've been driven higher by the likes of NVIDIA, AMD, and these other AI plays. But a lot of people out there, they are feeling like it's a recession. You're right.
Yeah. So obviously these Mag 7 stocks have been keeping the S&P elevated, and many of these broader indices elevated. Could you walk us through what are you seeing there? Are you seeing those start to break, or are they going to continue to hold up this house of cards? And so love to get your perspective there.
It's a really interesting thought process here. And for me, at least, I'm seeing the SMH, which is the semiconductor ETF. I think we have put in a major high here, and we could be looking at a 40% correction in the semiconductors. And I want to show you this chart and how I arrive at that conclusion, because everything I do is always based on technical analysis. Therefore, it's probabilities, right? So this is what we're looking at. This is the chart, the weekly chart of the SMH, which again is the semiconductor ETF. I'm going to throw my weekly 200 moving average on this chart. Now, what we see here is that here's your 200 moving average, right? And we went away from it in 2020. This was your COVID low. We rallied up and then we corrected. Here we went up again and we came back to home base. And that's how moving averages work. They very similarly are like pulling price back home. Now watch this. If we look at the furthest away the 200 moving average got from price, and we do a measurement here, look at what you get here, folks. This is absolutely remarkable. 102% above the 200 MA. Now, if we go over here and we say, okay, here's your high in 2024 before this 40% drop in the SMH, let's find out how far away we got there. And lo and behold, 102% away. Now, again, you guys probably see where I'm going with this. How far away were we from the 200 weekly moving average as of last week's high? Let's do that measurement here. Let's bring it up. 102%. And so the idea here is, as a technician, I see that, okay, if this 102% matches this, which matches this, and each time we saw a big correction from that extension move, the idea is we should be due for some sort of correction on the semis. And the reason I'm mentioning that is because the semis are the crux of why the stock market has rallied, right? I mean, that's NVIDIA, that's AMD, that's Broadcom. I mean, these trillion-dollar names, that's carried the market, that's carried the day.
Yeah, for sure. Yeah, I was actually in Taiwan Semiconductors after Liberation Day, and I actually got out of the position when it performed significantly well, and it just kept going up. And so, I was looking at that like, wow, I wasn't expecting this to continue rallying like this, and so it's kind of interesting just looking at even that with the SMH charts as well, because I'm sure
Yeah,
TSM is in.
and one thing I'm just seeing on the Taiwan semi chart is it looks like you might have a head and shoulders pattern formation here. Here's a shoulder, here's a higher head, and then a shoulder over here. Now you haven't broken the neckline yet, but if this breaks right here, now you're going to get that bigger drop to the downside on Taiwan semi. So Taiwan semi could be topping as well, just along your same point of while it's gone up and it seemed to defy gravity like all these names have, at some point we know they got to pay the piper, right? They all retrace at some point.
Yeah, definitely. So let's say we get this 30-40% correction in many of these tech names. Many folks have the mindset of buying a dip and such. And so what's kind of your take on that, and what should investors be careful of in with that mentality?
Yeah, so I think that this is the key, right? And you're so right on this, is that we've seen V bottoms over and over again play out, whether it's small drops on the S&P, big drops. I mean, the COVID drop in March 2020, that was a V bottom. The liberation sell-off low right here on the weekly chart, look at that V bottom. And so we really have basically the markets have conditioned investors. And by the way, a lot of investors have only come in since COVID, right? There was this huge awakening of younger investors coming into the market. Again, I don't want to sound like an old fogey here or anything like that, but there was a time where you could have a bear market that lasted and you didn't see a new all-time high for years and years, but we've got accustomed to it being almost within a month of a big drop. And I do just mention to people that won't last forever. I mean, look at Japan, look at the US in the dot-com era. When these collapses occur, they can be so detrimental. It can take, NASDAQ took 15 years to recover. Now, a lot of people will be saying, oh, well, it's a different market. I disagree. I think human emotion is what runs the market, and greed and fear. And so if it happened before, it can happen again. And I do caution people about being too aggressive to buy the dips now.
Yeah, definitely. Okay, so for folks that typically watch some of these episodes, they may say, well, the Fed is going to cut rates more, the money printers are going to come on and such. The Fed's going to come with the helicopter money and save the markets. And so what would be your caution there? What's your perspective on that particular argument?
Yeah, so for me at least, when it's that particular argument, right? And I think one of the things that I'm very particularly aware of is that it's not always as easy to just print money forever, because essentially what you're doing is you're diluting the underlying fiat currency. And so the buying power of the dollar starts to depreciate more and more, and there will be implications to that. And so it's not as clear cut as saying, oh, well, if they just print us out of this, they can't always just print us out. Look at Zimbabwe, look at some of these Venezuela, right? I mean, these are countries where they did that. Are their economies doing great? Are their people doing great? The answer is no. When you crush the dollar, you will inevitably hurt the buying power of U.S. citizens, and they will struggle to afford basic goods. I mean, there's a reason why inflation picked up. It's because they printed too much money in the COVID era, right? And that's a reason why we're now paying the price for much higher prices and the kind of the inaffordability of the housing market, groceries, and all these other things. And so I would just caution people is that it's not as easy as just saying, oh, well, we'll print our way out of it. There are repercussions to doing that.
Yeah, gotcha. So, and one of those consequences of money printing is the price of gold measured in dollars moving up. So if we can move over to gold, gold has been facing some pressure lately. Obviously, it had a huge move. I've been telling folks like gold moved up about $1,000 over the course of what, 4 months. So that's a huge move for gold. Gold does not move like that. And so then it's cooled off, and I've been kind of wondering, are we consolidating now, or are we under some pressure? Because right now we do have layoffs, we do have a government shutdown. where folks may need to tap into some liquidity and such. I don't know how many of those folks may own gold or whatnot, but I'm wondering if some of those economic pressures could be a headwind for gold in terms of people needing to sell that gold to get liquid.
And I think that's exactly what it is, right? So gold is usually a safe haven asset. So when things get bad, people want to buy gold. But the problem is people have been buying gold and it's a larger part of their portfolio. And so when we see the stock market decline sharply or the crypto markets decline sharply, there will be some margin calls in those groups, which will then cause people to have to sell some of their gold to cover those margin calls. And I think, again, this is where leverage comes in. People have gotten way over leveraged in the stock market. In fact, I was looking at margin numbers. People are borrowing more money than they've ever borrowed before to invest in the stock market. That's great when it just goes up, but when it corrects, that creates margin calls, and that money has to be found somewhere. And again, I think this is where the case for a pullback in gold comes in. And so you can see on the chart here, this was my first target on this pullback here at 39.48. We obviously hit it. We bounced. Now we're starting to break lower. My next target is 38.45. After that, we're looking at 36.95. And the big level where I will be accumulating in a major way is this max drawdown level at 34.85. At that point, we're almost back $1,000 lower on gold. Now, a lot of people will be hearing this and saying, oh, it's never going to go there. I want to show you guys something that's really, really cool here. Let's take a look at gold. We'll split the screen up here. And I want to show you guys going back to the period here. Let's go all the way back on the weekly to 1979. All right. And this is one of the coolest things. This is how I actually basically called the top on gold back when we were getting to those high levels. As I looked at the chart, and I'm just going to clean this up a little bit here, but I looked at the chart of gold in 1979, and it was identical to the chart that we were currently forming. Now, you might say, well, how is that even possible? I mean, that was 45 years ago. But look at this. Look at how gold behaved going into this period. So you have this, essentially, you have in 1979, this beautiful move up. Then we had this consolidation phase. In 2025, we had the move up, the consolidation phase. Then literally in 1979, we had 9 months of upside in gold. So 9 consecutive months of up. 1, 2, 3, 4, 5, 6, 7, 8, 9. And we had this big correction. Look at over here. 1, 2, 3, 4, 5, 6, 7, 8, 9. And lo and behold, we're now correcting. And so we are mimicking the 1979 to 1980 top in gold. Now, I do want to make this clear, is it is different this time. Yes, the pattern is repeating. In 1979 and 1980, Volcker was raising interest rates 18%, 15%. I mean, it was just incredible versus now the Fed is cutting rates. All right. Also, the GDP, debt to GDP was 30% back then. It's 130% now. And so for the thesis here is that while the pullback is going to be deeper than most people think, I actually think we hit new all-time highs in 2026. And so I think it's going to be much more shallow versus in the 1980s. We didn't actually hit new all-time highs, I think, for like 20 years on gold from that top in 1979, 1980. So I don't think the pullback will last as long, but I still think we'll retrace. And I just want to show one other thing here on this chart, is that if we look at how deep the pullback was before we kind of got our first big bounce in gold, it basically went back to essentially that major pivot high right here where we consolidated, right? And so here you can see it pulled back right there. Okay. So the idea here is the same thing could be replicating where we pull back to about 3,500 and then we start our next leg to the upside. And so anyways, at least that's my view on it, is that I'm a big long-term bull on gold. I've been holding gold for years and years and years. It's great to feel like it's finally paying out. I'm sure many people feel like that, but it doesn't mean it's immune to pullbacks. We just have to be realistic about it and then buy those dips.
Our project is right in the southeastern corner of Wyoming. In the space of 4 years, fully engineered, fully permitted.
The ASIC is what caught my eye, $937 per ounce.
110,000 ounces per annum. First year of production is the most impressive. 132,000 ounces of gold, 24 million pounds of copper. You really want these things front-end loaded like that. US Gold Corp is a near-term, low-cost gold producer in Wyoming. To learn more, go to usgoldcorp.com.
Okay, so there's a lot of a lot of headlines. I mean, we've had multiple high targets from the big institutions that align with your projection that gold will ultimately hit all-time highs, new all-time highs in 2026. We also have the narrative of the debasement trade, and then you also have TINA, which is there's no alternative. And so just thinking about
Right.
all of that in terms of, okay, like you mentioned, back in the 80s, they had the debt to GDP was a lot lower, and they could raise interest rates to pay someone, 18% yield on a U.S. bond or whatnot. And other nations began to dump gold and accumulate treasuries for a significant amount of time since then. And so just thinking about that, like, what is the alternative now? I don't think the Fed is going to raise rates that high. I mean, it would cause a lot of economic damage, and it would be political suicide, I think. But just kind of curious in your thoughts on that.
Yeah, so I agree with you. It's far different than the 1980s in the way it is, and I think that's why the base case for me is this is a pullback where we should see new all-time highs in 2026. So yes, it's going to be a pullback where it could come back as much as, another, I mean, we're trading around 3,900 and change. So we could come back another $400, $500. But at that point, I think you have to buy it because you're right. What's the alternative? I mean, are you going to go into treasuries when they're cutting rates? So you're going to get a minimal return on those. I mean, what, 4%, 3%, whatever it's going to be, especially when fiat's getting printed like crazy by the Federal Reserve. Debt to GDP, like you mentioned, I think those are other factors where central banks are telling us what to do. They're all buying gold, right? And so while gold is reacting emotionally, so you're getting this sell-off and you'll probably have the margin calls causing more selling pressure, people taking a little bit off the table for profits, inevitably the trajectory should be much, much higher. And I still think gold, we could be looking at gold in a few years at 10K. I don't think that is out of this realm, considering a recession in the US or globally. The amount of printing that would have to be done to get us out of that would be massive, and gold would be the main recipient. I mean, Bitcoin to some extent, I think, as well, but that's more of a risk on, risk off asset, right?
Yeah, definitely. Yeah, I do want to get to Bitcoin here shortly, but could we transition to silver and get your perspective on silver?
Absolutely. Let's take a look at silver here. Yeah, so silver, and this is, by the way, this is just a remarkable chart as well on silver. So a lot of people were thinking silver would rip higher, way past this 55-ish level. But look at this chart. This is a parallel. So parallel meaning that this bottom line is perfectly parallel to this top line. This is your low in 2008, so your financial crisis low. This is your low in COVID. If you take that line, right, so let's just go back to that and say, all right, here we draw this up and we bring this to the high of the bull market in 2011. It gave us precisely our high in 2025. Now, just like with gold, I think that, you're going to get a pullback here, especially with an pseudo-industrial metal like silver. But I would start looking to buy once we get back to about the $43 level. All right, you have a level here and you have an upsloping trend line in this range here. But these are both levels where I would start to really heavily accumulate. Basically, once we get below 43, I'm buying all the way down as far as it wants to go for that next leg up. Because I still think, again, yes, it's industrial, but it's still a metal, right? So it has to be denominated in terms of dollars. And if dollars are depreciating, by default, silver should go up.
Yeah. Even with that industrial demand, it's very bullish. Just the industrial demand has been picking up significantly over the last 5 years. The mining output has been not meeting the demand, and so now we got this issue where industries are wanting to take delivery of the metal and such, and willing to pay higher than the futures price for spot and such. And so it seems like it could be a silver squeeze but this time with industrial demand, and you still have the investment demand as well.
That's right. I agree 100% with you. So I do see silver potentially at $100 in a few years. It's just a matter of you got to flush out the weak hands. And this goes for gold. A lot of people get very upset when you're talking about any asset that they're long pulling back. But there was a point where you saw that parabolic move in gold and silver. And that's where you start to get people that are thinking, oh, this is the easy investment, right? And for those of us that have been long-term gold holders, there's no such thing as easy in gold, right? Or silver. So, those people have to be flushed out, get the weak hands out, get it back to its hardcore level, and it'll start grinding higher again and make new all-time highs.
Yeah, for sure. So we'd like to transition to Bitcoin. So recently, the United States surpassed $38 trillion in debt, and $1 trillion was added within 3 months, which was a significant fast pace and such. Gold has been holding up fairly well in these economic storms. Bitcoin has been compared to gold as the digital gold. It seems like it has not been holding up, and just looking at the behavior of how the asset is performing, to have a more objective look at it. And so just wondering if it has Bitcoin decoupled from the risk on equities and such. I mean, even some of the equities have been NASDAQ and S&P have been hitting all-time highs. But Bitcoin, I mean, I think it reached the all-time high here recently in the last few months, but it's just kind of been just rolling over, and folks haven't been posting about it as much. And so I'm just curious your thoughts on there and what the charts are telling you.
Yeah, it does. And I agree with you. Like, you look at the performance of the stock market, and there's been a divergence where Bitcoin has been much, much weaker than the stock market. And usually they go up together and they fall together. And the thing is you didn't see Bitcoin making new all-time highs when the S&P was making new all-time highs. But today the stock market's falling and Bitcoin's getting smoked. So it's like, it's the worst case scenario, right? Where it's not performing with the markets to the upside, but then tagging the markets when the markets drop, it drops. Now, again, one of the things to keep in mind here is that if you look back at 2017 in the bull run and 2021, interestingly enough, Bitcoin topped out 4 to 6 weeks before the stock market. So it was almost like a leading indicator. And the question is, today is the 4th of November, right? And the high on Bitcoin was basically, it looks like October 6th. So essentially a month ago. And so I wonder if Bitcoin wasn't seeing selling by bigger players that knew the market was coming. They were de-risking in Bitcoin first and then looking to now unload into equities. That's what I would say. Now, a couple things to note here on the chart is we do have a major technical trend line coming into play around 93 to 94,000. Basically, the beginning of the bull run, which started here in October of 2023, when Bitcoin was about 26,000. You can see it continues to rise, but every time it comes back to this line, it tags it and goes back up. And so we're getting closer to that level here. And that's going to be the big test for Bitcoin bulls. Can that level hold? If it holds, then we're really still in an uptrend on Bitcoin since the beginning of this bull market rally from the 2022 lows and starting here in 2023. But if this breaks, that's really bad for Bitcoin. So again, as a technician, I'm watching this 93, 94,000 level. I will probably play it as a swing trade for a quick trade, but I'm really more focusing in, does it hold or does it break? If it breaks, we probably go to 75,000 on Bitcoin. I know that sounds crazy to a lot of people, but remember, Bitcoin in its correction phases has really 70% drawdowns. That's not unusual. This wouldn't even be a 50% drawdown if it gets back to 75,000. So again, overall, Bitcoin weak, showing itself as a weaker asset than the markets right now, maybe a leading indicator, but watch the 93 to 94,000 level.
Yeah. Well, and I know you don't want to be that "I told you so" guy, but I mean, if 75,000 sounds crazy, I mean, people were calling you crazy back in 2021, 22? Yeah. And they were like, Gareth, this is not going back to, I forgot your price target, but it ended up hitting, I think it tagged 14,000 in that downtrend.
So, yeah, when it was 69,000. Yeah.
Yep, exactly.
No, it's true. And the thing is people have to remember is that, one of the things I've trained myself on from now over 2 decades of trading is I'm very logical, right? Logical to the point where my wife gets annoyed at me, right? She's like, "You're too logical. I want to see more emotion." I'm like, "Well, this is how I am. I'm a trader, right?" But ultimately, people get very emotional about things that they're long and they can't understand why it would correct. But if you take a step back and you look at charts and you look at crypto, it's very clear that it does have these drawdowns. It has these 4-year cycles. It has big drawdowns. And so you just have to go with that. And if the charts are telling me that, then that's what I'm going to say.
Yep, you got to trade with the chart, not with your heart. And
That's right.
and then you also have to look at, like, I think, your time horizon. So if you are parking money into these assets for the long term, obviously it's in the uptrend over the long term, whether you look at Bitcoin, gold, and such. And so if you're in the long term, then you shouldn't be worried about the near term performance and such. And so that's
so
important.
true.
So I do want to go over to the rare earths. So I played a little bit of the rare earths. I was able to make some money. I got out of it, and these stocks have just been getting pummeled lately. And so just wanted to see what the charts are saying, and if you have any. Are you touching these? Are you touching these falling knives, or what are you thinking here?
So number one, I love touching a falling knife, right? Because people get scared of that and they say don't do it. I'm a believer that if you have enough technical factors and you do it small, right? A lot of people go all in and then they're like, oh no, it didn't work, right? But if you nibble versus going all in at the right technical levels and you dollar cost average, then you can catch the bounce. And so just to show you on MP, right? MP materials here, incredible run. I mean, just absolutely incredible. There's a very key gap fill around 48.50. I might start nibbling there. Now, listen, I have to leave it open that there's a massive gap here that it could eventually fill. So I would see myself adding to this in this range around 39 and then again at around $30. But if I could bring my average by dollar cost averaging right into this line, right? If I start here, I buy here and add here, then my average would be somewhere right around there. You'll get a bounce on these. There's no doubt about it. Buy the dippers will be back. It's just a great flush. So there will be trading opportunities in these. These are one of my favorite type of scenarios because when things get so parabolic, the retraces are massive, but the bounces after the retraces are equally as massive. Like you could see 50% gains on some of these things. So again, I love them, just not quite yet as a buy.
Yeah, gotcha. And then can we look at one ticker, LEU? Centrus Energy, they do uranium enrichment. And I had bought them back in during Liberation Day. They hit about $48, some change, $50, $55, something like that. And this stock just ripped to the upside to over $400. I didn't hold that way up, but I was just kind of thinking, like, okay, is this sustainable or what? Like, this seems like it's trading at meme status, and so just wanted to see what the charts say on this one.
So this one's interesting because in the near term, see this trend line here that goes back to the August 2025 lows. Notice how it kept on tagging this line over and over again, right? So over and over here, it just tags it. And then look at today. It opened below, but it's recapturing that trend line. And so it technically speaking, this is still holding this support line. Now, if this breaks, that's where things get a little bit more nasty. But in terms of this wouldn't be something where I would say, oh, it's falling off a cliff. It's actually holding on to the edge of the cliff right now. But again, just be careful because I do worry that we're at the starting point of a bigger correction. And if it does fall, where would I buy this? I would start looking at the lows in April, right? So the lows here, this would be a really nice trend line. Look at this. So let me get rid of these other ones here so we can just kind of keep it as clean as possible. So we're going on the assumption here that it's going to break lower. Where would I buy it? Very clearly, this area here, you have this hit here, right in here. And then look at this area. If we draw a trend line from this top, it basically merges right over with that same level. So you have this area of support with this upsloping trend line of support merging together. That to me is the buy level right there. That should be a big bounce off that level.
Yeah, gotcha. Yeah, thanks for covering that. Any other general thoughts on just where we're at in the markets and how are you positioning yourself? Are you getting into cash? Are you playing puts? Are you what's Gareth up to? Are you buying? Are you buying the VIX?
So a couple things. So number one, I do have shorts out there, no doubt about it. I've been kind of anticipating the drop in the market coming. We've been so overbought. I love that Michael Burry came out with these big short positions via puts in NVIDIA and Palantir. And so definitely have shorts out there. I also have longs, but they're more in defensive names, like a Pfizer that is trading at a forward PE of 8, pays a 7% dividend. It's not flashy. It's not going to make me 100% like some of these AI stocks, but it's a way to just say, okay, these money flow may see kind of a readjustment from some of these big players into these kind of defensive names, and they could actually have a 5, 10, 15% move while also paying a very hefty dividend. And I think, again, for me, that's kind of where I'm angled at this point, is to play it more safe. Definitely have some cash on the sidelines, because like we looked at some of these charts like MP, LEU, if they flush enough, then absolutely I want to be buyers at those levels. Just got to be patient.
Yeah, you got to have dry powder to take advantage of those opportunities.
Right.
And as my friend Rick Rule says, it gives you the courage. You got to have the courage, to get in and take advantage of those opportunities. So
that's right.
I appreciate you for coming on the show, Gareth. Where can people connect with you, find more about your services and everything? Plug the audience.
Hey, sure, absolutely. And thank you for having me on. So verified investing, it's where I like to say it's no BS, just charts, meaning that we focus on probabilities, not hype and all that craziness that is all over the internet these days. It gives me, honestly, it's the only way I've been able to be a profitable trader, by focusing and using the charts, which is, again, probability. So just check us out at verifiedinvesting.com.
All right, you all got the information. Be sure to hit the subscribe button. Also, click the link that is pinned in the comments below to the Vancouver Resource Investment Conference. Love to see you there. And thank you, Gareth, for coming back on the show.
Thank you so much.